Well, when is the gold price going to move? I say 2000. In the year 2000, it was $253 an ounce. Now it's $2,400 an ounce. It's increased at 8.4 or 8.5% compounded for 24 years. So when is gold going to move? 24 years ago. People are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too. But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance.
In today's episode, Rick Rule stresses the importance of preparing for economic uncertainty rather than succumbing to fear. He highlights the recent unwinding of the Japanese carry trade as a reminder that economic warning signs are often ignored until it's too late. Rule suggests that investors should construct their portfolios to safeguard against potential risks, drawing parallels between Japan's longstanding debt issues and the current U.S. economic situation. He warns that just because these problems have persisted for decades without a crisis doesn't mean they won't eventually cause significant disruption. Rule is particularly concerned about the real yield on U.S. dollar-denominated deposits, arguing that inflation is eroding purchasing power more severely than many realize. He points out that the Consumer Price Index, CPI, fails to account for critical expenses like food, fuel, and taxes, which are major components of household budgets. This, combined with the U.S. government's mounting debt and unfunded liabilities, suggests that the financial system is more fragile than it appears. He cautions that this fragility could lead to a scenario where interest rates rise or equity prices fall, making it essential for investors to stay vigilant. Despite these concerns, Rule sees opportunities, particularly in gold. He notes that gold is underowned in the U.S., representing less than 0.5% of savings and investment assets. Historically, during times of economic uncertainty, gold has served as a reliable store of value. Rule believes that if interest in gold returns to its historical average, demand for precious metals could surge, leading to significant price increases. He views gold as insurance against collective stupidity, a safeguard against the economic mismanagement he sees as prevalent today. Now we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps.
Traditionally, during periods of time when investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities, the primary beneficiary has been gold. Gold is underowned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially underowned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold, but I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant. People from your show talk to me and they say, well, when is the gold price going to move? I say 2000. In the year 2000, it was $253 an ounce. Now it's $2,400 an ounce. It's increased at 8.4 or 8.5% compounded for 24 years. So when is gold going to move? 24 years ago. People are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too. But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance. At the U.S. economy, they say, well, why should American debt to GDP at 120% be problematic? The Japanese ran for a long time, over 200. It went on until it didn't. The Japanese individuals had much higher per capita savings than the Americans do. And hence, they could afford to be stupid for longer. I remember, and you'll understand where I'm going with this in a while, being not unsophisticated financially myself, driving 20 years ago, and seeing a big billboard on my right, on the right of the freeway, that said, borrow 125% of the value of your home. Bad credit, okay. And I remember as a lender thinking, I'm not sure this works out okay. But I didn't correlate that complacency with the crash of 2008, although they were directly correlated. It turns out that people don't pay too much attention to warning signs that are statistical until the trap has already been sprung. People should go out and look for catastrophe, and having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency. That's all I'm suggesting. And I think that the events of last week likely make your audience a fertile resting place for that admonition.
In today's news recap, will rate cut hopes ignite a silver rally? Silver prices remained stable on Wednesday, hovering around the pivot point, which is currently guiding the market's short-term direction. Unlike gold, which is nearing record highs, silver traders are adopting a cautious stance, with little momentum pushing prices decisively in either direction. This lack of volatility suggests that investors are not expecting significant market-moving news from today's U.S. Consumer Price Index report. The modest support for silver prices on Wednesday is largely due to expectations of a potential U.S. interest rate reduction and ongoing tensions in the Middle East. However, the market remains sensitive to upcoming U.S. inflation data, which could influence the Federal Reserve's monetary policy decisions. Despite these supportive factors, low demand from China continues to weigh on the market, potentially limiting any substantial rally in silver. Investors are closely watching the latest inflation data, particularly the core CPI, which excludes volatile food and energy prices. Expectations are for a 0.2% increase from the previous month and a 3.2% rise year over year. The data comes at a time of growing economic uncertainty, with some investors questioning whether the Federal Reserve should have already begun cutting interest rates. According to CME Group, traders are currently split on the likelihood and size of a rate cut in September, though the consensus leans towards some form of easing. U.S. Treasury yields edged lower on Wednesday as the market absorbed the latest inflation data and its potential implications for the economy. A confirmation of slowing U.S. prices could bolster bets on a significant rate cut in September, potentially driving silver prices higher. Additionally, geopolitical tensions, particularly in the Middle East, continue to fuel safe haven demand for silver. Now, we'll show you the best clips of the latest interview, but first, hit the like button, subscribe to the channel, and check our description for full vid credits. Enjoy the episode.
Opportunity. The risk is the fact that most people believe that they enjoy a real yield on U.S. dollar denominated deposits. When people in the United States look at inflation, and when people in other countries look at U.S. inflation, they rely on the CPI. The slogan for that is that it's the CP lie. It doesn't measure the deterioration of the purchasing power in U.S. dollars. It doesn't include, as an example, food or fuel. So an inflation index that doesn't include food is of very little use to me. But more importantly, it doesn't take into account tax, the largest household expense of most working households in the United States. When I calculate the increase in the price of the goods and services that I use to live, including government, which is neither a good or a service, what I see is that the purchasing power of my earnings and my savings is declining at 7.5% compounded a year, not 2.6. If I juxtapose that with the yield available on my savings in the U.S. 10-year Treasury at 4.3, rather than earning the delta between 4.3 and 2.6 as a real yield, I'm losing the delta between 7.5 and 4.4. And what that means to me is that the natural direction of interest rates is higher, or the natural direction of equity prices is lower, and that people need to pay attention to that. Mm-hmm. That's, I think, really the first thing that I look at. The other is related to it. It's the inexorable increase in government debt. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. On-balance sheet liabilities of the U.S. government in 2008 were about 25% of GDP. Is an index that tracks the price of goods and services that the big thinkers of the world believe that the average household consumes. Mm-hmm. But they exclude the price of government. Now, Julia, if I didn't have to pay the tax, I'd bitch a bit less about the index. But the truth is that the average North American household, Canadian and American, directly or indirectly, loses 43% of their household budget to tax.
Mm-hmm. Yeah, that's true.
The idea that a cost of living doesn't include tax is absolutely silly to me. And government is consuming 43% of our income, despite the fact that between on-balance sheet and off-balance sheet liabilities of the government, they are 5 times GDP. That is to say, they're financing a bunch of it, and it still consumes 43% of income. The idea that somebody constructs a household budget without including tax assumes that person is very stupid. But the people who generate the CPI are people who are constructing a model household budget while leaving out 43% of household expenditures. How can they do that?
What do you think of today's show? Do you think gold and silver prices will be manipulated to the upside moving forward, squeezing the big banks and making a fortune for the average Joe that is stacking metals? Post in the comments section your honest opinion, share this video with someone who hates Bitcoin, and send a super thanks if you find our recaps valuable. Now watch this video right here because it's a perfect fit for you. I see you on the other side.